affordability continues to be raised as an issue, but prices keep rising. Factors that are keeping property prices high haven't changed. We still have very expensive construction costs, still very difficult to get labour. There's a supply challenge. All of those things are compounding. You throw in a few interest rate cuts and things start to change quite dramatically.
An interest rate cut.
Interest rate cut.
Interest rate cuts
have pushed up property prices.
We know every cycle is different, and you can't look at a previous cycle and say, all right, well, last time interest rates rose, this market did this, so therefore it'll do it again. And I think a lot of people really got caught out with Gold Coast. There's definitely varying impacts of different infrastructure. A hospital's probably better than a sports stadium. I mean, there's probably a way there.
It's Brisbane's new Olympic precinct.
The biggest infrastructure spend in the state's history.
One of the things we have been talking a lot about is what's the impact of the Olympics on Brisbane, and the impacts aren't always that positive.
Welcome back to another episode of the Property Nerds podcast, and we love it more than ever when it's not just us three nerds, Adrian, Jack and I, but we get a fellow nerd joining us in the world of data-driven investing or just data overall. In this particular case, we had Nerida Conisbee, the chief economist at Ray White, join us for the show. Now, this is her third time on the show with us, so it's really exciting to have her back again. Today, we uncover more on the trends of interest rates and the likelihood impacts of some key cities. Number two, we go into the world of infrastructure, things like hospitals, train lines, what makes a difference, what hasn't, and the importance of understanding sentiment in the world of infrastructure. Lastly, we also go into the world of data, but from the eyes of Ray White. What makes them different? How does their business collect data and go deeper into it to unpack it from multiple angles, whether it's commercial property, residential property, auctions, and more. So let's speak to Nerida, chief economist at Ray White, on the Property Nerds Show.
Nerd alert!
Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Nerida, welcome back to the Property Nerds.
Thanks for having me.
Well, it's been great just actually having you on, not only once, but twice on the show before. You're a fan favorite. Everyone really gets to go into the numbers, into the insights, something you do so well. But in the last time you joined the show, you were with the REA Group, now a chief economist at Ray White. So we'd love to dig a little bit deeper into some of the new and key insights, I guess the key differences that you're really uncovering in your time here at the Ray White Group as the chief economist versus, say, previously at the REA Group.
Yeah, sure. I guess they're quite different companies. They're both in property. REA Group is an advertising company, so they create listings and put them online to sell homes. Ray White is actually involved in the selling of homes, and it's a little bit broader than that. They sell homes. There's a private equity component of the company, Ray White Capital. There's commercial property. Loan market is part of the White family's businesses, and as a result, it is very, very diverse. So I think that's probably one of the main differences. One thing's the same though, both of them have invested very, very heavily in data, which is why I've ended up at both places. REA, when I joined, were at the beginning of a data journey and had just recently started using all of the insights, particularly around search. At the time, they were using Cotality data. While I was there, they switched over and bought a company called HomeTrack. And so then started to rename that PropTrack and started to use their own insights. Very similar journey at Ray White. So Ray White, again, very heavy investment in data, using a lot of the data from insights from within the business, things like auction bidding data, things like time on market, very much focusing just on Ray White data. But since then, I've also established a data team focusing on property data, which is a company called Nerds, and again, a very, very heavy investment in that to make sure that we have interesting insights and also to create a revenue stream for the company.
That's really cool, Nerida. You mentioned a few things around the investment in data, but also quite a few different areas with this data that you have, whether it be residential, commercial, auction data. You also mentioned lending data as well. Do you think that having all of these separate insights and data and bringing it all together has really developed the insights or the general broader trends that you've seen?
Yeah, absolutely. I think one of the things that is quite interesting about my role is that I've obviously got the data and so I can do very, very deep insights into the data, and I've got a team of data analysts and, so they're also super clever and looking around and seeing what the trends are. But we also get a lot of really interesting insights from the business. So talking to agents week to week, month to month can be really interesting. Quite interesting end of last year. So when we're looking sort of around September, October, I was in Brisbane at the time talking to agents and they were saying, the market's really hot, it's doing really well, we don't know when it will slow down. And then by November, I turned up and they're like, oh, it's really changed, open for inspections, they're not as strong as they were. And at the time, price growth was still showing, it was still showing pretty decent price growth, but then November and December in Brisbane ended up being quite weak. And so it gave us a little bit of a quicker insight into what was potentially happening in the market.
I'm interested to know that there's like Ray White Group I thought it was just a sales agency company taking such a big interest in data. Like I'd expect that from a buyer's agency, but not so much on the sales side. So just educate me on that, why that is.
Well, there's a few things. I guess one of them, big ones, is brand. So I do a lot with our media team. I do a lot of media, I do a lot of television. So it's good for the Ray White brand. Also, we do a lot of events. My team does a lot of events. So that could be industry body events. It could be events for our Ray White businesses. So, for example, I was in Ipswich last week talking to a group of first home buyers with our loan market and our Ray White businesses. Vanessa Rader and my team is speaking to a group around superannuation, investing in superannuation. And so that's a critical role that we play is allowing for engagement with consumers. And then I guess just giving our agents something different to talk about. So, we do write a lot of content. So I write a weekly piece. Vanessa Rader writes a weekly piece. I've got Asham Gotian in my team who writes very, very data-heavy pieces, but making them, very consumer-friendly. So that's a component. And also just giving them material to give their clients. So one of the really big projects for us this year, we do a monthly report called Ray White Now, which is a market update. We are now we have worked out a way to localise it on a suburb level basis. So I think, with the emergence of AI, writing text was always a bit that prevented us from providing, volume in terms of suburbs. But now with AI, we are able to do that.
It's funny you mentioned the content that you put out, because when we were before the podcast, Adrian mentioned that he actually received one of your weekly
distribution.
Timed well.
And it was surrounding interest rates. So could we shift the conversation to interest rates? Do you see any immediate effects on the interest rates coming down, or any kind of delayed effects that are going to happen?
Yeah, it's been really, really interesting since the end of last year. So I mentioned before that a lot of the market, everywhere was slowing down. November and December last year, we were seeing month-on-month price declines, even in very, very hot markets like Perth. And it looked like the market was, it had taken a while. It had taken a lot of interest rate rises to slow it down, but it was finally happening. But then in January, we started to see a very distinct change in the market. So there wasn't many auctions. We weren't able to see it through our auction data, but we started to see it through our pricing data quite quickly that prices were starting to increase. And it came earlier than expected. We knew that a rate cut was looking highly likely in February. But I think what happened is that a lot of the insights around the interest rates cuts coming through started to become more common knowledge. There was a lot of data that was coming through to show that inflation was under control, the economy was slowing, it was highly likely that the Reserve Bank would cut in February, and as a result, prices started increasing from then. So we started to see that happen. We continued to see growth accelerate through February, March, and then by June, it was coordinated. We were then seeing coordinated price increases across the country and accelerating price increases. So,
is that just instant sentiment? Like, people just think, oh, the rates are going down, let's go right
borrow
now.
more. Yeah, probably. I guess we are in a constrained supply environment, so it makes sense. If you have more money, you spend more money. So I think that definitely is the case. But then I guess all the underlying factors that are keeping property prices high haven't changed. We still have very expensive construction costs. It's still very difficult to get labour. There's a supply challenge. So, all of those things are compounding, and you throw in a few interest rate cuts and things start to change quite dramatically.
Nerida, on the interest rate parts, one unique dynamic to this time as well is that it's almost, there's a few cities now that have actually had a really strong run, the Adelaides, the Brisbanes, the Perths, but they did that in an environment where interest rates were skyrocketing. And so when you have the trends of interest rates likely hitting down for some time, if that's all occurring, when you look at past data, how do you look at the future data with a slightly different lens here? Or do you maybe consider it, well, no, they've had a lot of growth, so even if interest rates did come down, it can't keep going for too much longer? Or do you look at it as going, I get that they've had a growth cycle in the last few years, but we're in a different set of fundamentals now, and you can't just use the last 3 or 4 years thinking that cities can't keep outperforming, because if the cost of money does get cheaper in some of these markets, we expect longer legs for some of these growth cycles. I know it's a lot in there in that question, but I think the key is there's so many investors looking at these cities and they're saying, I still like the fact that it's quite tight in supply. I still like that the rental markets are tight. There's rents still likely to grow strong. Prices could still grow. Infrastructure, great cities, lifestyle. But then they're just worried about continually investing here because of the past growth. But then as you pointed out, this year they all seem to be roaring again, like the likes of Adelaide, Brisbane and Perth. And so what are your thoughts on these three in particular?
I think you have to look at fundamentals. But we know every cycle is different, and you can't look at a previous cycle and say, all right, well, last time interest rates rose, this market did this, so therefore it'll do it again. And I think a lot of people really got caught out with Gold Coast, because Gold Coast historically has been a boom bust market. It rose incredibly during the pandemic. Interest rates started to rise and everyone's like, oh, okay, here we go, it'll just crash back down. And of course it didn't happen. It was a very, very minor decline and started shooting up again. I think with property markets at a localised level, you do have to look at the fundamentals and think through what's happening here. And if we look historically, Sydney and Melbourne have been very sensitive to rates, but the reason being is that they are they were the most expensive market, so they're not the most expensive. Particularly Melbourne's not the most expensive market now. Yeah. If you have a look at an area which we basically would look from, say, Byron Bay up to Tweed Heads, Gold Coast, Brisbane, Sunshine Coast, that area is just attracting enormous amounts of population movement. And that seems to be fundamentally underpinning the growth. Warm weather.
We were just there in Cairns for end of financial year and we had a great time.
It was winter. I was walking around in a singlet. It's great.
Yeah, best time to be there. I was in Melbourne last week, so I didn't have that
Opposite.
Yeah.
Was it snowing?
Not quite, but it's cold. So that area is continuing to see a lot of population growth. Very expensive to build. Will it see the same growth as it's seen over the past 5 years? Probably not. If you have a look at a market, I was in Ipswich, as I mentioned before, a couple of weeks ago. Ipswich prices have doubled since prior to the pandemic. So the median's gone from about, $375,000 to about $750,000. Could Ipswich keep growing? Potentially, but it's certainly not going to double over the next 5 years. So I think, you do need to be mindful of past performance, but you also have to be mindful of the fundamentals. And also, I guess the other thing is around affordability, although, affordability continues to be raised as an issue, but prices keep rising. So it is an interesting one for us to look at, because, why can prices in Sydney just keep shooting up when we know that people are really struggling to get into the market?
Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show. Fundamentals, another element of fundamentals is something that you've studied quite closely also, is the world of infrastructure. And so when we look at infrastructure, especially major projects, whether it be hospitals, train stations, or all these sort of things, how have they affected markets in your review? Obviously, people think everything infrastructure must mean everything's amazing, but sometimes they don't always match each other in the way we think. So what are your reviews of infrastructure, like major projects? Mentioned a few of them there, and how have they affected housing markets in your review?
Yeah, so we did a piece on this at the start of the year, because it is one that everyone says, like, they're adding a train line. What will it mean to my house price? What will it mean to values? And so it is something that we constantly talk about, but never really had done a peer review on what the impacts have been. So we went through and we did a peer review, and what we found was the big studies that have been done show that a new ferry terminal is really good. So probably a few other things. You're near the water, and we know people like water.
Yeah.
So that was one. But the other one was really a train line was the second, had the second biggest impact. So if you get a new train line in, obviously if you're on the train line, backing on the train line, it's not great. But if you're in walking distance to a train station, that makes a significant difference to property values. From there, you do start to see things like major projects such as major freeways. Obviously not great if you're super close to it. If you're a bit further away, it does lead to a benefit. So it does depend on the infrastructure and what it is, and also your proximity to it and how much you can benefit from it. But even at a very small level, you look at a local retail centre, you put in a fantastic cafe and suddenly that whole retail centre lifts, suddenly that neighbourhood lifts, and they can be quite subtle, the changes to the availability in a neighbourhood and what the impact is on values.
Yeah.
Do you see those infrastructure projects overlaying? Like if there's going to be a train station, does that mean there's automatically going to be a freeway? Or because I know that wouldn't be the same for ferries. There's no ferries going out in Campbelltown.
Yeah.
No.
I know there's a new train line going through Leppington down there. I'm sure that's going to extend. Does that mean that there's a freeway that's going to be added there, or?
Yeah, not necessarily, but I think you do raise a good point about investment in areas. And, one of the things we have been talking a lot about, it's particularly in Brisbane, is what's the impact of the Olympics on Brisbane. And when you look through research on the impact of property values, the impacts aren't always that positive, but it's also a lot to do with how well the Olympics have been implemented, but probably more importantly, the infrastructure that has been provided. So somewhere like Sydney, the fact that they put stadiums out at Sydney Olympic Park and they made a heavy investment in getting accessibility out to Western Sydney because of the Olympics did lead to a rapid change in the way people viewed that area. And so I think, we know that in New South Wales, Western Sydney is a huge focus by the government to make sure that it is very livable, and as a result it will continue to lift values the more that they invest in those areas.
When we talk about the infrastructure, you've sort of mentioned a few different types, like, train stations being really, I guess, the most impactful for different areas and price demand. But if we were to talk, I think a lot of people usually are always targeting hospitals. That seems to be one that people really think are important. And if we were to sort of categorize them, say as an example, hospitals versus, sports stadiums, as you kind of mentioned, how do you see them sort of value against each other in terms of price growth or demand?
I think a hospital's probably better than a sports stadium. I mean, there's probably always a ranking. But then again, if the stadium has been well located, or I don't know. There's always different factors that can lead to a change. But if you have a look at a hospital and how many people will regularly use a hospital, it's
employment as well.
Employment as well. Actually, yeah, that's absolutely true. So there's definitely varying importance of very impacts of different infrastructure. There's even negative infrastructure too. No one wants a cemetery in their backyard. So there's always different things that people really don't like, and as a result don't really want to be in a suburb or be close to that facility.
Yeah. So for your everyday person who's looking and judging infrastructure for potential price demand and price growth, would it be safe to say that general rule, look at ongoing employment for that?
Yeah, employment is absolutely important. And I think too, there's also the rezoning that comes through from employment. So if you have a look at, say, the Northern Beaches Hospital in Sydney, it wasn't necessarily the hospital itself that led to a significant uplift. It was also the zoning changes that went through. So you had a lot of, standard suburban homes on 600 square metre blocks, and suddenly you needed a lot of high density to accommodate workers. And as a result, the values increased a lot. Similarly, with a lot of the planning changes that are being made around train stations at the moment, you've got single homes that are suddenly worth a lot more because developers can get much higher densities on those properties.
Nerida, on the infrastructure piece, another thing me and Adrian often chat about is there's so many phases of infrastructure. There's like the sexy announcement, everyone's going crazy, the political microphone comes out, it's like, we're going to do X, Y, and Z. And then you've got the next part, which is the shovels start digging and doing things. Jobs start popping up all over Seek in the anticipation of all that. And then you go to the part afterwards where you're like, I can use it. It's working. Has there been any part that stood out more when it comes to whether it be investment sentiment and activity, or whether it be actual following price growth onto local areas? Or was this one sort of, it really, really depends on which project and why? Because that's always an interesting part. Some people are talking about a city because X could happen. Some people talk about a city because it's happening. And some people talk about a city because I can now use the plane to go to the city or use the train to drive from this, get from the suburb. Where is it ranked for you in terms of the importance?
There's probably two that we can see where there is a significant uplift. So the initial announcement often doesn't, because people aren't sure whether the project will proceed. And
how long does when you do the announcement, how long till it actually starts construction?
Well, it could be. I mean, you look at Western Sydney Airport, it was 50 So, I think Western Sydney Airport is a very good example because, everyone knew it was coming, but it just was coming and no one kind of knew when it was going to come. So, so that initial announcement, people don't, they're like, oh, well, that's interesting. That would be great. I don't know if it's going to happen. And then, you go through the various planning stages, and then once the project has been committed, that seems to be the first lift. So that's when people are like, okay, this is going to make a significant difference to this area. I'm going to invest here, or I'm going to buy here because I want to live near this, whatever the infrastructure is. And then from there, there's a disruption stage. So, you're starting to have the infrastructure being built, and at that point, it's pretty flat because, living near a big construction site isn't often that attractive, and the area may not look great. It might be terrible to drive around or park or whatever. And then the project's completed, and at that point, we see another lift. So it seems like, there's always different types of people. Some people are happy to buy in early and, look at what the potential impact will be, or look at what the potential impact will be. And then other people are like, I'm going to wait until it's up and running before I take a jump here. So I don't think, but from analysis we've done of some projects, that seems to be the timeline.
Yeah, what I'm really picking up as well, just on this whole topic of infrastructure amongst us all, is like, it's very much varying from types of infrastructure and the importance of it. Second is the stages, not getting excited too early. And there's clearly impact, right? Whether it be a place for people to live, and maybe it's a supply response and more places open up from zoning, or whether it's genuine uplift, whether it be all the jobs created during and post. I think the biggest thing we always talk about internally is like infrastructure spend per capita as a result we look at. You can't get super excited by that in isolation. It's one part, but we know that some things just cost a lot more, like a wind farm or like, say, a renewable energy project, but the post-job creation isn't as high. And I feel like just hearing today has made me realize even more so. It's like, let's get down to the detail of different types of projects, what's happening, and then let's not get too excited until something actually is properly committed. So Nerida, it's been amazing to have you on again on the Property Nerds show. Thank you so much. And really excited to see the things that Ray White's doing in the level up of data. Us being property nerds, the lovers of data in the world of finance and property, we really get excited when companies like that are actually taking charge with it and really investing in it, because it's not only helping all the teams in the offices at Ray White, but just the end consumer, the end seller, the end owners of properties, or those even considering buying properties. It's not even to do with your customer, it's all Australians just benefit from better education, learning more, busting myths, not falling to the traps of just the local boots on the grounds and everyone's exciting voice around why they should do something, but going from macro down to the micro, back up again, and just getting real clear. So thank you for what you do and your team as well. Really appreciate it, and looking forward to having you on again in the show.
Thanks for having me.
Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.